Here's another business basic lecture. And this one is kind of a general introduction to business. So, what's the objective of business? Lots of people will debate this. Lots of people will debate it. But from my perspective, it's to maximize a firm's value. And we can debate also if long-term value or medium-term value, short-term value. Certainly not short-term value, but maximize a firm's value over the long term is probably the best way to do that. And the way that the firm can accomplish this is by focusing on providing value for customers. Ultimately, a business is a private enterprise set up for the interests of the owners. Now, those interests of the owners generally are financial interests, but they can also be social interests. But let's just talk about the financial interests now. So the business is set up for the financial interests of the owners. That's the primary objective. The best way to long-term secure that objective is to provide value for owners. But at the same time, when you value for customers. But at the same time, when you provide value for customers by developing products and services that meet their needs, you also create value for owners, and you also create value for society. So entrepreneurship is a unique endeavor where you create value for customers, for owners, and society all at the same time. Now, if the owners have different ambitions and they want to have a more balanced approach, they want to generate some sort of social value, they're free to do that. It's a private business, and they're free to do it. What I like about the living in a free society is that you, the owner, the capitalist, the entrepreneur, the business person, you get to decide what your objective is. And if you decide it's social, then great, it's social. If you decide it's not social, then it's not social. That's perfectly fine. The objective of nonprofit businesses can vary as well. Okay, basically a nonprofit. We could also discuss the difference between a not-for-profit and a nonprofit. One of them is interested in not making profit. The other is interested in not distributing that profit to owners. And you really need to keep in mind that businesses that are not-for-profit or non-profit, they're not about free. They have to generate money, generate capital, generate cash, equity to pay their bills, and also to reach their objectives. And you don't do that without any. You don't do that for free. Okay. The difference is that their ultimate objective may be a little bit different, and the fact that they don't deliver or distribute that capital. For example, a university, a private university. Hundreds of millions of dollars involved. Okay, but the ultimate objective, of course, is not to benefit the owners, because there are no owners per se. So, the objective of business, in our context, okay, is maximize a firm's value. Key stakeholders. Who are the key stakeholders? Now, a stakeholder can be defined as people who have an interest in the business. And they can include owners and creditors and employees and suppliers and customers. I'm not a real big fan of talking about stakeholders in a business, because you could argue that basically every person, every interest is a stakeholder in the particular business. So it kind of is a diluted phrase that doesn't really mean a whole lot, at least to me. So I limited talk. Let's talk about shareholders, the owners. Let's talk about creditors. Let's talk about employees. Let's talk about suppliers, and let's talk about customers. But let's not call them stakeholders unless you absolutely have to. The business environment. The business in general is within a context, within an environment, and there are lots of actors in that environment, and many of them are large. And here are some of the large ones. Okay, the industry environment, in terms of the competitive environment, the economic environment. How's the economy, locally, nationally, internationally? These days, global economy has an impact at the local level. The global political system, what's going on there? Politics in general, state, local, federal, international. Technology, what are the trends in technology? The social environment. Okay, not just demographics here, but what's going on in how people view their lives. What sorts of things are they interested in? What's going on with their neighbor? How do we interact with our neighbor? All of these things are the environment in which business has to be started and business has to develop and grow. And all of these things, to a greater or lesser extent, have an impact on the decisions that we make as we start, grow, and build our particular business. Here's a slide that was done, a small business survey, and you're looking at how business in the United States by the NFIB, which is a very large National Federation of Independent Business, a very, very large organization made up of small business owners. Whereas, how do they allocate or divide their time in various business tasks? And as you can see here, production was the biggest here with 42%. Strategy was not that big, 10% strategy and planning. Other, 17. It would be interesting to see what that other means. Finance, they don't spend that too much time on finance. They spend very little time. Personnel, we can talk about that. Is that a wise thing to do? And they spend almost somewhere between a quarter and a fifth of their time in marketing. So that's how small business owners allocate their time. So what are we going to talk about today? We're going to talk about key business players, stakeholders, if we want. Describe some key business functions. We are not going to talk about how to develop a business plan, at least in this particular lecture. Business defined. Business is an enterprise that creates and provides value to customers and owners, usually through the delivery of services or products. Absolutely, that's what we're talking about. Okay, a business is an enterprise that creates value for customers and owners. That's what it does, and that's what we're focused on. Profit. It's important. We're going to talk about this in a number of different slides, the finance slide in particular, but you got to have a basic understanding of profit. And at the end of the day, revenue minus expenses is profits. Revenue, some people call them sales, some people call it turnover, and expenses, costs. Expenses minus revenue equal profits. Okay, on the very basic level. Okay, I'm sure you know this, but if you didn't know it before this lecture, you certainly know it now. No excuse. We talk about revenue, we talk about profits. Revenue is not the same thing as profits. Sales is not the same thing as profits. Don't get those mixed up. Okay, these are various players, stakeholders in the business. Again, customers are among the group the most important. Okay, but we have the owners of the company, we have the people who run the company, we have the customers, we have creditors, we have suppliers, and they all interact in a way that creates value for customers, that creates value for owners. It also creates value for government in terms of tax, increased tax base, and also when we pay, another reason why business is valuable to society, because we're paying people salary. So we pay people salary, they pay some taxes, also the money that they have, they spend, and that helps create wealth for somebody else. It helps spur demand. So this business process is one that is very important. And you can see the different lines here of money going and revenue going and loan payments going and supplies going. Again, I think you know this stuff already. Okay, you might not have thought about it with this specificity, but you know it. Okay, so if I ask you a question to redraw this, or at least draw the lines between owners, customers, suppliers and creditors, I'm sure you'd be able to come up with something like this. If you weren't sure of it then, I'm sure of it now. A word to the wise. Key stakeholders, again, owners, entrepreneurs, stockholders. We talked about stockholders in the ownership slide. Okay, when we talked about the benefits and the disadvantage of different forms of business ownership. Creditors. Who are creditors? Creditors are companies or individuals that extend credit to the business, meaning they loan money to the business. Okay, they're not investors. They loan money, and money that needs to be paid back. Money that needs to be paid back with interest. Employees. Employees are stakeholders. They certainly have an interest in the business. But not just managers. Okay, not just managers, not just supervisors, not just executives, but operatives as well. Now, real briefly, okay, the definition. A supervisor is a person that has supervisory responsibility over at least one person. A manager is a person that supervises supervisors or supervises managers. An executive is a manager that is at the top of the organization that manages managers. And at the bottom of the organization, the people that supervisors supervise, we call them operatives. Okay? Operatives is what I want you to call them. I don't want you to call them workers, because if I'm an executive, I'm a worker too. If I'm a manager, I'm a worker too. If I'm a supervisor, I'm a worker too. So you disrespect everybody in the firm above operative if you call the operative a worker. Suppliers. Suppliers also have a key role to play as a stakeholder, because obviously they are delivering the goods and perhaps services that we need to build our product or service. And we need to establish relationships with suppliers. We need to have good relationships with suppliers. And what you'll find in entrepreneurship, if you can have a really good relationship with a supplier, I mean, suppliers can be great. They know things. They know details. When we start talking about entrepreneurship in particular, suppliers can tell you information about other competitors. Suppliers can loan you money. Okay, it's hard to build your product or service without suppliers. Okay, so suppliers are very key, and then ultimately the customer. That's why we do all this. That's why we go through all of this. Okay, for the customer. Resources used by business. Here is not an exhaustive list, but natural resources, human resources, people and such. Many people would argue today that human resources are the most important resources. We could discuss that. Physical resources, financial resources, social resources. What other resources can you think of? Well, here's one. Technology. We could argue that technology is not a resource, but let's just say for argument purposes that technology is a resource. And we can define this technology as knowledge or tools used to produce products or services. So when we talk about technology, it's not necessarily high technology. Technology has a broader definition than just high technology. Okay, so I don't want you to be so influenced by what you see and read and hear. I want you to think and speak with specificity. I want you to be really detailed and clear with what we're talking about. Okay, technology. Entrepreneurship. We could argue that entrepreneurship is a subset of human capital, but entrepreneurship is a resource. Okay, it's a resource that we can use, we can develop. I mean, that's what we're doing in this course. We're helping develop our entrepreneurial skills and capabilities. So we are able to go out and create the businesses that create the value for customers and ourselves and our fellow owners. Okay. Let's take a quick break right here, and we'll be back in a moment.